Hey, what's up, good people? How you doing? Welcome. Happy Saturday. A lot happened. Hey, listen, if you're new, hit the like, subscribe, and that notification bell only if you're new. But if you've been rolling with me for a while, continue to hit that like button. It does help. We got a lot to get into today. I'm not going to bore you with a lot of stuff. Let's just get right into it. Dow closes 700 points lower as inflation tariffs are worsened. Okay, that's one of the things that we have going on. I'm going to play that in a minute. So this is what I want you to know. We had PCE that came in hot. We're going to play that in a minute. I want you to listen to it because it's a lot of important information. Income did rise slightly. The question is income rising with inflation? So it doesn't matter if inflation goes 3% and you get a 1% raise, you're still losing money. Followed by, or should I say, compounded with the tariffs. Now, the president this week announced another 25% tariff on cars that are not manufactured here in the U.S. That is heavy. That's going to hit the car industry heavy. It has hit the car industry really heavy. Then you had big tech like Nvidia that was weighing the entire NASDAQ down. Big tech. Okay. So all of this negative news on top of it was Friday, and all of the fear just compounded, and the market literally fell apart on yesterday. It fell apart on yesterday. It absolutely did. You can look at some of the numbers here and you could see that the market fell apart on yesterday. Now, I know a lot of you usually don't listen to this data. I'm going to play a short 2-minute video. I want you to listen to what happened, and I want you to look at the indices as he announced these numbers as PCE came out, and we're going to talk on the other end.
February income, spending, and PCE. Expecting the income number to be up about 0.5%, maybe up 0.4, double that, up 0.8. And up to now, no revisions yet. That follows up 0.9. Up 0.9 last month was 1-year high. Let's add in 0.8. This is solid back to back. Now, if we look at the spending side, last month at -0.2, that was the first negative number in 2 years. It was the biggest negative in drop in spending in 4 years, but we reversed it to some extent, up 0.4, about as expected. And if we look at real spending adjusted for inflation, last month, -0.5%. That was the first negative in a year, the biggest drop in 4 years, but yet we reversed that, but in a smaller way. Adjusted for inflation, up 0.1. And now let's take a look at the PCEs. We'll start out month over month, expected to be up 0.3, comes out at 0.3. If you look at year over year, expected 2.5, it comes out at 2.5. If we look at the core now on a month over month, expected up 0.3, a little warmer, up 0.4. That would be the warmest going back to, wow, I'm going to have to go. That'll be the warmest basically in a year, January of 24. And finally, if we look at core, year over year, expected 2.7. It's a 10th warmer as well. 2.8. 2.8 will be the warmest going back to, well, the end of last year we were 2.86. So this one remains sticky. Revision.
So, guys, you heard that. Listen, income was slightly up, all right, but not up with inflation, okay? Spending dropped. That's going to affect GDP, all right? Core PCE was hot. That's the Fed's preferred indicator, inflation gauge. That's what he looks at, the PCE, personal consumption, right? And that's a big, big number, right? So let's look at this, good people. Look, this is the Dow. This is the S&P. We could see what happened. It fell by 2% on yesterday alone. For those of you that don't know, for an indice, that's a lot for an entire indice. That's the S&P 500 of top U.S. traded companies, right? And so it fell. As a matter of fact, if you go to the week, we're down 3%. If you go to the month, we are down even more. As a matter of fact, the S&P now, from the highs, this is just an average, we're close to correction territory on the S&P. down by 9%, right? So we are looking at that. Then if you go here to the NASDAQ, which is tech heavy, we see that it was down. It got hammered with companies like NVIDIA weighing down, big tech weighing down on this. All of the tech companies are in this ETF, okay? And we're going to talk about this more on how you can make money on it, all right? And so now we got the last 5 days. Look at that. That's huge. 4% in a week. That's a huge drop. And look at that. Then if you go out here, you can clearly see from the local high. If we go here, you could see that we are down 14% on the NASDAQ, okay? And again, good people, for those of you that don't know, that's a lot. Now, I'm going to talk about VUG here because it is, and I want you guys to understand why I have these various ETFs, right? We know that QQQ is tech heavy, right? You can write that down if you don't remember that. That's going to be important. Then I want you to look at, not limited to, okay? I know there's other ones, okay? But this is the Vanguard Growth Index, okay? So I'm diversified. I have big cap. I have Vanguard Growth. And then I have QQQ, which is tech heavy, right? So just to give you guys ideas, there's many funds out there. All right, so VUG is that, here's the ticker symbol right here, VUG, okay? Vanguard Growth. All right, so we could see that it's down by 4%, and it's also down. Let's just go to the high here, December. As a matter of fact, let's just go to the local high. You can see we're down by almost 14%. So growth stocks are in this index. Follow? And so you had companies like NVIDIA that was just weighing down on QQQ. You know, look at that, down by 8%, down by 12% over the last month. Remember, this was the darling. NVIDIA and Tesla were the darlings that was just holding the market up, right? Two of the Mag 7 that was strong. Even Tesla gave it up on yesterday. It could not hold out. 3.5 plus 1.34 going down, all right? But it's been doing well, actually. It's been defying, but still down 10% for the month. For those of you that don't know, this is not correction for Tesla, okay? Tesla can come down by 20, 30%, and we're still not in a correction territory. You got to look at the indices for that and not the individual stock. And so someone say, hey, why are you buying ETFs and not individual stocks? This is why. Because individual stocks could fall way more than an entire indice or ETF. Follow? Now, there's a time to be buying ETFs or these type of funds, because if you're long, these are long, and we could have a lot more to fall. But let me just keep going, all right? Let me just keep going. On yesterday, I went over this. Here's VUG. Here's the growth. We could see that the 200-day moving average, here it is. You can see it, that blue line. We've been over this. Every time it touched, boom, boom, boom. Even when it came close, you could have bought. But we are entering into, I want to be clear, and this is why I wanted to make this video. We could do what we did in 2022. For those of us that remember that 2022, we broke under the 200-day moving average, and we fell. We fell greatly, all right? This was a huge fall under. It went down 25%. So remember, every time it fell by another 5%, we were like, this has got to be the bottom. Then it fell again. This has got to be the bottom, all right? I just want to warn you guys of this, okay? I want you to see that this could happen, all right? Let's go over this because this is why I'm making this video today, all right? So this is growth, okay? And a lot of the stocks that you guys are in are growth stocks. So here's what happened in 2022. Broke beneath the 200-day, right? Fell. Look at that. 11%. Everybody was like, this is the bottom. I'm putting all my money in. All of my cash is going in. Just buy the dip, right? That was 11%. Then what happened after that? It it came back up, and a lot of people thought it was over, and then it fell another 21%. All right. Then everybody was like, oh, this has got to be the bottom. It's got to be the bottom, right? Because we had an 11, then we had a 21% fall, and then what happened? It recovered and then fell another 20%. You guys see what I'm saying? And all the while, here's my point. All the while, if you're trying to guess the bottom, sorry about that, good people. All the while, if you're trying to guess the bottom, it's almost impossible because this is not market induced, right? This is tariff induced. Let's just call it what it is. This is tariff induced. So now, what do you do, Larry, if it's tariff induced? When should I get in? Nobody can tell you when you should get in. All I'm saying is that at some point you just have to start buying. So if you're here and you just held or you just DCA'd, right? Even here, you were up 12%, right? When we touched again here, you were up 12%. And then if you zoom out, if I learn how to use my tools here, good people, sorry. Now remember, this is on the weekly, okay? This is on the weekly. So even if, good people, even if you bought an ETF right here when it touched and you just held, you would still be up 27%. That's what I'm trying to tell you guys. And then I've been buying Granny. Why Granny shots? Okay. It's large cap. Okay. It's large cap. And that ticker symbol is GRNY. It's large cap. And Granny is doing the same thing everything else is. It's down by almost 15%. And so that's why I'm buying these ETFs while they are beat down. And then me personally, I wait until the market has shown a strong support and it starts to rebound, and I'm not going to try to guess the bottom. So I'm not deploying all of my cash right now. Not all, but I did put in a chunk. And so I wait until things go under. So I didn't buy any VOO. I bought the Qs because of where they are, okay? And I bought VUG because they're all hovering around negative 14 to 15%, right? So then what I do is I wait until a 10% correction is really in play, and then the next drop down I start to buy, like I've been telling you guys, right? And then I wait until a 15% drop, which we are nearing. Then I buy some more. And then I just stop and just let it continue to fall. And then if it goes by 20%, that's when I start buying again. All the while saving some dry powder. All the while, if you have a job, every single paycheck, you should be paying yourself by putting money into your broker accounts and saving some dry powder and not deploying all the money that you put in. I know some people says, I need to have all of my money going to work for me. Not in times like this, not like I've been saying for a while, not while the market was top heavy. And so you save some cash for times like this because no one knows where the bottom is. And the truth be told, technicals are showing that we have a lot more to fall. That's what the technicals are showing, right? But what could trump that is Trump. Trump could turn around Monday and say, we're working things out and I'm going to pull back. And then those technicals are going to show what was just announced. So I'm buying because this is news driven right now and I have a time. I'm buying ETFs. I'm not buying a lot of stock, right? All right. And I'm starting to look, there's some of the quantum computing that I've been looking at that I've been just nibbling a little bit, still having 90% of the money that I'm going to put in it left over, okay? But the ETFs is what I'm focused on right now, right? Hey, I got some links below. I want you to check them out. I want you, if you really, really are scared, I'm telling you right now, in your funds, those of you that have your retirements, if you sell, you lock in your losses. Every single time, history has shown you all you have to do is wait. Now, I'm not telling you, I'm not licensed to be telling you what you should be doing. But I can freely tell you that if you go out to the max of the S&P 500, and if you would have freaked out in 2007 when it bottomed out and had you sold everything, you would have missed out on a 540% run since then. If you had sold everything at the bottom of COVID, you would have missed out of 124% gain on the S&P 500. Follow? If you go back to the 90s, that was a long, brutal one, right? If you go back to 2022, which is I was just showing you guys, when it dumped under the 200-day moving average, and you sold, you missed out on a 56%. So all you have to do is hold for those of you that have a lot of money in retirement, okay? Now, I'm not a licensed broker. You need to check. You need to do your own due diligence, okay? I'm here just to show you what history has proven. And remember this, the New York Stock Exchange was established, for those of you that think this is a fluke, the market, in 1792. That's how old this game is. And the market has recovered 100% of the time. All right, good people. I'm going to leave it right there. I want you guys researching this weekend. And for those of you that don't have it, you need to download the top link below, which is Stock Up You, and get serious about your money, your future, and your retirement. All right. I love you guys. Live, love, laugh, and learn. We'll see you tomorrow.